Hello everybody. In this time we are talking about budgetary management. The meaning of budgeting, also known as budgetary management in business accounting, is a process of overseeing and tracking income and expenses. Businesses often have budgets for individual departments plus an overall company budget, and managers are frequently responsible for managing the budget for their department. And then we move to aspects of budgets. The first aspect about revenue. This is income from sales, investments, or other sources. All income should be recorded in the budget, and you should always note whether it's pre or post tax income, so it's easier for your company's accounting department to handle business taxes. And then the second aspect, savings. Just because your department has some extra money to burn doesn't mean you should allocate it. Holding money back for unexpected expenses, especially when you have a surplus and don't work with a lose it or use it business, can help you stay prepared for future events. And then the third, operating expenses. Operating expenses are the costs associated with running the department or business, such as machinery upkeep, rent and utilities, and some of these expenses are fixed, like insurance and licensing fees, while others are variable, such as marketing or research and development costs. And then fourth, employee expenses. These expenses typically comprise a large part of company, department, and project management budgets. They include any expenditures related to staffing, such as wages, employment taxes, and health plans. And then fifth, capital expenses. These are capital investments in the department or business. Capital expenses can take many forms, such as a new building or upgrades to an existing facility. Other forms include patents on new products and the development of new technology such as phone apps. And then what does a budget manager do? Rather than being a specific job position, budget management tends to be a responsibility that falls within the scope of many different jobs. Some businesses do hire budget managers whose sole purpose is to manage and monitor a specific budget or group of budgets. But the task of managing a budget can technically fall to any employee. Budget management takes place at all levels of a business. The higher up the budget hierarchy a specific budget lies, the more complex the processes and workflows involved in budget management are. For example, managing the budget for an individual team's monthly social activities would be very simple. The budget would be outlined by the department, and a budget owner would calculate what the team could afford, usually on a per person basis. However, the higher up the budget hierarchy you go, the more work there is involved in managing a budget. Dependencies, stakeholders, processes, and the amount of money included in the budget all increase significantly. And then we move to the types of budget management. The first type, zero-based. This type of system is built from the ground up. Since starting fresh is time consuming, executives choose to use this method in one department at a time or over the course of several years. This forces a company to evaluate and cut non-essential expenditures. And then the second, value proposition. Budget managers or department heads use this type to analyze each line of the budget to determine whether an expense's value is worth the cost. While value can be subjective and tricky to quantify, this method can help leaders tailor a budget to its desired outcomes. And then the third, incremental. This moderate system uses a company's existing budget as a base. Organizations then adjust as needed for the upcoming time period based on inflation and on the projected costs. This method is popular due to its simplicity. And then fourth, activity-based. This one is built from the top down. The goal is to analyze cost drivers and optimize productivity and efficiency. The activity-based method is time intensive and helps a company save money because this type is future focused. Historical data isn't necessary. That means even new organizations can use this approach. And then we move to the benefits of budget management. The first benefit, assisting in planning. Budget managers can use past budgets as historical data when making decisions for the future. For example, a department head might consider past years' spring expenditures when creating a new budget with a rolling forecast. And then the second, making decision-making easier. A detailed budget and strong management simplify the decision-making process. For example, looking at projected growth makes it easier to figure out whether funds are available to hire new personnel. And then the third, monitoring progress. Current budgets can be closely monitored to make sure revenues and expenses work as projected. A manager can catch higher than average outflows and suggest smarter spending solutions. I think it is enough for this session. Thanks for watching, and don't forget, give this channel with your like, comment, subscribe and share. Thank you.